I'm joined here by my fellow panelists. We got Raphael from Alcott, a project developer. We got James from Kita, an underwriter, and Sid from Arbor, who also is an underwriter. And unfortunately, we have lost our fourth panelist. She had to catch a flight home, unfortunately, because hers got cancelled. But you're stuck with the best of the best here. So we're going to talk to you about insurance. And I'm going to start off by sort of saying about myself, because this time last year I worked for Toucan Protocol, very much in the ReFi movement. And then here this year, I'm representing Howden, which is a giant insurance company. And I didn't really see that coming this time last year. I would not have expected that. And a big move for me to go from the sort of startup world into the corporate world. But part of the reason I did that is I was looking at, what opportunities there were at Toucan, and was working with a few people who are actually here today on the concept of a tokenized forward credit. And we kind of worked it out from a technical perspective, but the thing that was missing was a way of guaranteeing the number of forward credits turning into issued spot credits, and the way of doing that was insurance. And this led me down a rabbit hole of looking at insurance and what it might mean for the voluntary carbon market. And the thing that was really, like, for everybody who's probably spent a whole week this week listening to problems about the voluntary carbon market, it's a large issue is of scale and attracting capital and investors. And actually, what I started to learn was that the power of insurance, as it were, was the ability to attract capital in the way that it can de-risk things for investors and therefore allow more investors and capital to flow into the space. And so I started looking at this, and then the more I sort of went into it, the more I realized there was a whole range of different opportunities for how insurance could play a role within the voluntary carbon market. And basically, early on in my career, I worked at JP Morgan and used to finance these projects, and we'd have a long checklist of due diligence points where we had to get people happy and comfortable with the risks that we were taking in an investment. And the way I see insurance now, and the way that we're sort of positioning ourselves at Howden, is thinking about what are all those risks within the project lifecycle, what are all those checkpoints that someone's going to have to check off for their investment committee, and understand that some people will be comfortable with some risks, some with others. Every investor has a different risk profile and appetite, but for those areas where they don't have the appetite for it, there is the ability to transfer that risk away, and that mechanism for doing that is through the insurance market. And the goal of creating products for the insurance market that is look at each one of these individual risks is to basically create a checklist so that we can speed up the way that investors go through their due diligence, which will attract more investment into it. It will speed up the process and grow the market. So that's how I think about it. But what we're going to do now is to go into some of the details of how insurance links up with data, with investment, for the project developers on the side. So I'm going to kick off by asking James about whether you could set the scene, really, for what kind of products are out there. Can you add some color to this?
Yeah, sure. Thanks, Charlie. Hi, everyone. I'm James, head of insurance at Kita. At Kita, we insure carbon, so we're building insurance products to de-risk high-quality carbon removal and allow them to scale. We think insurance has a massive role in de-risking the financing and getting a lot more investment into a needed space and ultimately carbon capture and storage. We look at this in many ways, and this is probably how the insurance market is looking at it at the moment. It's looking at the life cycle of a credit, It's thinking about the different stakeholders in that ecosystem, so the investors, the developers, the intermediaries, the brokers, marketplaces, exchanges, and then also the different types of carbon removal, so the avoidance removal, nature-based credits, but also the engineered solutions, the biochar, ERW, all that good stuff. Our first focus was looking at de-risking the investment of corporate buyers and investors into pre-purchased or forward purchase credits. So the main risk there is that there's a lack of supply of high quality credits. Corporates want to do the right thing, and therefore they pre-purchase to guarantee that supply. That comes with risks. We insure them if they don't receive their credit. So you buy X tons of carbon at Y price for delivery on date Z, almost said Z, and for whatever reason you don't receive those credits, we make you whole. That's sort of resonating with part of the investor landscape, but we also want to build new products, and as the rest of the market will do. One key thing that we don't insure that we're looking at and the market needs a response for is political risk. So in an earlier panel we were talking about Article 6 risk, so the risk of just general expropriation by governments of a project, but there's also the carbon angle. Is it a carbon expropriation? Do you need the authorization to issue the credits and to be able to trade them overseas? So that's a lot of interest in that space. And then when you look at the life cycle, a big one is around reversal and permanence risk. So once it's stored, obviously nature-based are really prone to reversals, but what about DAC? What about other emerging sources? And then we're also thinking about the role of insurance in the buffers. So at the moment, the buffers are a natural inbuilt insurance mechanism, but is that really the most efficient use of capital? And can insurance have a role to play in just kind of releasing some of that capital for the rest of the developers? And I'll stop there, but maybe worth handing over to Sid there to talk about the parametric side.
Sure, yeah. So as you may know, Arbel's focus has been parametric insurance since inception. A lot of the insurance we cover are for various types of climate risk, whether, if temperatures are very high for a sustained period of time, here's a payment. If wind speeds are really low and you're a wind farm, here's a payment, all measured by highly localized data sets. When it comes to carbon offsets, and specifically, for example, forestry carbon, if you guys were around earlier, we talked about the Cyclops system. What we're trying to do is build measurement systems that can then become the index or the underlying for a parametric contract. So, for example, if you can assess the health of a forest at a granular level, say biomass, or directly the carbon sequestration, then if there is a catastrophic drop in that biomass, for example, if the forest burns down, or if there is a drought or human activity, that can then trigger an automated payment based on that biomass data. Doesn't need somebody to go show up at this forest. That is going to be one of the keys to scaling the carbon offset market, because a lot of these projects are in places that are difficult to reach, difficult to send people. And specifically in forestry, the places that are most vulnerable are the tropical forests, and they're not exactly places that are easy to send someone on a ground survey. By taking that human element out, you are able to de-risk the project to a substantial degree, but you're not, you're not incurring a massive cost of compliance there on the insurance side.
Yeah, and I think it's worth adding to that, a real life example. We've recently been working with a project developer who is doing a mangrove restoration in Bangladesh, and the way this insurance product works is, when I'm new to the insurance industry, so it kind of blew my mind when I heard about this parametric thing, which is in the traditional way, an event happens, so in terms of mangroves, a storm would rip through them, and let's say you spend $1 million on it, you've just lost your $1 million effectively. But you then would have to make a claim, they'd have to get someone around to assess it. That assessor, called a loss adjuster, would then say, this is how much we will pay you back, and then they will pay you back. And that whole process can take months, years possibly. And with this parametric thing, what we say is, okay, this is the amount we're insuring, it's $1 million, and this is the location of where the mangroves are. And then we allow the project developer to set some parameters around this, which is typically a radius, so they say like 50-kilometer radius, and the severity of the storm that they are wanting to insure. So storms are measured from category 1, 2, 3, 4, and 5, which is to do with their wind speed. And what the product does is say that if a storm enters the perimeter of this radius, the 50 kilometers, and meets certain wind speeds that are verified by satellite data, it triggers an automatic payment. And so you could be paid the next day. And maybe Sid, you can sort of talk more about like how dClimate's data like feeds into that product.
Yeah, so dClimate, as you guys know, has a wide array of climate data sets that are sourced from anywhere from national agencies to subnational agencies to universities. And so what we do is build institutional grade data pipelines that can feed into contracts like this. A lot of weather data, for example, gets overwritten all the time. dClimate, by its nature of being on chain, tracks every revision of every data set on there. And now we have, I don't know how many terabytes, it's quite a bit. When you make a financial contract, you need that traceability of the data from start to finish because you have a lot of money on it and you want to make sure why did it make a payout. And the example you gave, in that case, you would have, we have hurricane data sets there, but there are other examples, like for example, if you have a renewable energy credit, right? That credit generation itself, if it's coming out of a wind farm, depends on wind speed at the farm. And so by if you pull highly localized wind data from dClimate, then you can structure an insurance contract or a derivatives contract based on that wind speed, say over the next 3-4 months or a year, and that will help to reduce the volatility of renewable energy credit generation. That then allows this wind farm to get a lower cost of capital. And this is stuff that we already operate in. And what you can see is this nascent market to de-risk that carbon credit world.
And that lower cost of capital is like massively significant. If you're a wind farm or something, that means if you've got predictable revenue streams, then banks and other lenders are more likely to provide you with debt, so you can not dilute yourself and then recycle your equity to then put it into the next project. So it's super important. It's a technology guarantee which we've seen. It's actually fairly mature now in the sort of solar and wind renewable space, but starting to look at how that can be applied to emerging technologies like direct air capture, which I think we're not quite there yet, but it's like a super exciting possibility. Raphael, conscious you haven't said anything, and I'm going to move over to you now. And as Alcott, one of the most progressive developers in the market, the most progressive, obviously, how do you see this shaping up, like the future from a project developer's perspective, and can you try and link in the themes of data and insurance?
That's a big link, for sure. Insurance is a big missing piece of the puzzle, and it's really bringing a lot of benefits to really shape the demand side. It's also something that started to appear only in due diligence processes about 3 years ago, but not on the parametric or anything fancy. Actually, starting with civil liability. We started actually seeing demand and requests from potential investors to guarantee that the project was insured on the ground just for the people that were working on it. And you would be surprised of how many projects are not insured at all. So when we evolved into a space that is highly refined like parametric insurance, it's a new variable that can offer a lot of possibilities for us to be able to de-risk the project and also be able to assess the existing risk so that we can help to channel the funds directly into the project and bring a guarantee to it. And I would say that even if you're able to safeguard a portion of the credits, you're already like achieving something that is very significant. Nature-based solutions are very dangerous from an investing point of view because most of the time the only revenue is carbon. There are no collaterals, like for instance in renewable energies. And this is something that scares a lot of investors for sure, especially in a context like the voluntary market at the moment, which is definitely under scrutiny for many loopholes that have been taken and shortcuts that are commonly used. So it's a new space in which we start to believe there are like many opportunities and that can bring really complementarity inside the whole ecosystem that is much needed. So we're really looking forward to see use case, to see so unfortunately to see bad events happening, to see how it works. But the first time I heard about parametric insurance was only about like 3 months ago, and it blew my mind, especially on the renewable energy sector. There's obviously like a lot of coverage that can happen that can guarantee like good revenue streams. So this is at the end of the day what helps us to deliver like effective contribution on the ground that benefits to the ecosystem and the project success and the whole mission that is given to project developers to make their projects work.
Personally, I think like insurance can play a big role in improving the integrity of the market, because if project developers sold credits that were like quality guaranteed, you'd be putting the emphasis on the insurance market to make the stipulations of what they see as good or bad quality, and that would be like a market-based mechanism that in theory would make the credits attract a premium because they come with some sort of guarantee, which then would regulate and raise the bar for everybody, and you have some sort of like positive feedback loop where the credits have got better quality, that creates more confidence for investors, who then that increases liquidity, and when you've got increased liquidity, there's more demand, prices go up, and then that feeds back to the supply side of project developers wanting to develop more. So do you see, you must speak to a lot of customers, the end users, the corporates. What are you seeing, because this is all fairly new, this insurance market, like, are you hearing positive things from the customers, or are they even aware of it?
So yeah, I mean, they start to get aware of it. I think Kita has been really groundbreaking the floor and opening it up to the reflection about what it can bring. From an investor point of view, I would say that at the moment, most of the requests are coming from investors that are looking to like have a stake in the project. We haven't heard yet about customers on the trading side and the supply side that ask for it, but I would believe that they would see it as like an additional bonus point somehow. But now it's kind of, if you give a toy like this to investors, they will try to make the most of it. So the requests they ask us are difficult for us to shape. We're not insurers, so we have to turn to you guys to find out like the way to make it happen. And also like they start to have like more refined requests, like political risk, definitely like project risk, fire risk, water damage risk, any kind of risk that can happen. So it's very broad. I think we cannot insure everything, or I'm sure you guys can find ways to give me a quote on everything, but like at one point it will have like an impact definitely on the success of the project, financially speaking. But it's something that we really welcome, because it also helps us to understand like the way that you would assess the project, and it gives us like an additional layer of like scrutiny onto which areas we have to take care of in priority. So it's a very much welcome element to the scene, and we're looking forward to see some pilots and make it happen.
I mean, fantastic points. You sound like an industry insurance expert. So I'm just going to add that I think there's a real lack of integrity, uncertainty around the demand side in the carbon markets at the moment. We're waiting for CCP and the SBTI and ICVCM kind of guidance coming out later this year, and Article 6 mechanism to be matured. But we would argue that insurance is a key part of that pillar of integrity. You need MRV, you need the credit ratings. I know there's some credit ratings here, and you need insurance. And then that helps to both to put a premium on high quality projects, which they should be, a premium, and hopefully de-risk them. And then there's a backstop when, eventually there will be losses, and we need some protection there.
Especially if you start to get financing involved, right? When lenders get involved, especially on forward projects, they'll often demand insurance, and it often is how insurance becomes far more wide-scaled, is a demand from the lender side, right? So as we get into more forward credits and a more rich set of instruments in this market, you will naturally need more and more protective financial instruments against that uncertainty.
I'm very conscious we're running out of time. And I just wanted to also add, because Howdens is a broker and Kita being an underwriter, we've sort of been involved together since the early, when one of our team members helped at the Lloyd's Lab mentoring when Kita was first launching, but they have done a phenomenal job of getting their name out there and speaking to the market and letting people know that this exists. It's very impressive for such an early stage company. All right, thank you everybody, thank you.